Many investors fall into a common trap, chasing high yields at all costs. They see an enticing dividend percentage and dive in, only to find that over time, the net asset value, or NAV, of their investment slowly erodes. This NAV decay is like the foundation of your house crumbling, even if the fresh paint on the outside looks good. It means you're getting paid income, yes, but at the expense of your original capital. It's a vicious cycle that can leave you with less money than you started despite the payouts. But there's a better way. What if you could invest in ETFs that prioritize not only high income, but also the preservation and even growth of your principal? That's exactly what we're talking about today. Carefully managed ETFs focused on robust, cash-generating companies that pay consistent dividends and maintain or even appreciate their core value. It's about smart choices and true diversification. Let's kick things off with the dividend darling. The Schwab U.S. Dividend Equity ETF, or SCHD. This isn't just another dividend ETF. It's a pillar for income-focused portfolios. SCHD's popularity stems from its disciplined approach. It doesn't simply chase the highest yields. Instead, it meticulously selects companies based on fundamental strength, quality, a robust balance sheet, a history of consistent and growing dividends, and strong free cash flow. This focus on underlying business quality is precisely why SCHD rarely experiences NAV decay. It's not just about paying dividends. It's about holding companies that are built to last and grow their payouts over time. Historically, SCHD has demonstrated remarkable performance, not just in growing its dividend payments, but also in appreciating its share price. Its current yield is attractive, and its expense ratio is incredibly low, making it a cost-effective option. Its holdings are diversified across various sectors, featuring household names that are leaders in their industries. If you're a long-term investor looking for a stable, growing stream of passive income and prioritize quality and consistency, SCHD should absolutely be a cornerstone of your portfolio. Now, if you're looking for an even more aggressive yield without falling into the NAV decay trap, listen up. I've selected 4 more options that, for 2025, could deliver over 8% in income through smart, capital-preserving strategies. First up, consider JEPI, JP Morgan Equity Premium Income ETF. JEPI employs a unique strategy involving covered calls on a diversified portfolio of large-cap U.S. equities. This means it sells options contracts on its underlying stocks to generate additional income. Unlike some other covered call ETFs, JEPI aims for a more balanced approach, seeking to provide monthly income while also maintaining potential for capital appreciation. This active management helps mitigate some of the downside typically associated with covered call strategies, making it an attractive option for high, consistent income. Next, let's look at PDI, PIMCO Dynamic Income Fund. PDI is a closed-end fund, CEF, that invests in a diversified portfolio of income-producing securities, primarily high-yield corporate bonds, mortgage-backed securities, and other global fixed-income assets. While it operates differently from an ETF, its active management team excels at navigating complex credit markets to deliver significant monthly income. The fund's ability to utilize leverage and its active trading style can boost returns. But it's important to understand that CEFs can trade at premiums or discounts to their NAV. However, PDI's long track record of consistent, high distributions makes it a compelling choice for aggressive income seekers who trust active management. For those interested in the real estate sector, but with a focus on stable, high payouts, explore VNQ, Vanguard Real Estate ETF. While VNQ's direct yield might not always hit 8%, its underlying RATs often have consistent, growing dividends, and it provides broad exposure to the real estate market. The key here is to understand that well-managed REITs, the core of VNQ, are legally required to distribute a large portion of their taxable income to shareholders, which often translates to higher yields. Unlike some other high-yield REITs, VNQ diversifies across many property types, reducing single-asset risk. If you combine VNQ with a complementary income strategy, its foundational stability and dividend growth potential can contribute significantly to your 8% plus target without sacrificing principal. Finally, consider a specialized income ETF like QYLD, Global X Nasdaq 100 Covered Call ETF. QYLD explicitly sells covered calls on the Nasdaq 100 index. While this strategy can cap upside potential, it generates substantial monthly income. The transparency of its strategy means you know exactly how the income is generated. It's designed purely for income, often providing yields well over 8%. While it may experience less capital appreciation than direct equity investment, its consistent high distributions make it a strong candidate for those prioritizing steady cash flow. It's crucial to understand this trade-off. You're sacrificing some growth potential for higher, consistent income. Now that you've seen these powerful options, how do you put them together? Diversification is absolutely key. Don't put all your eggs in one basket. SCHD can serve as a robust, quality foundation, providing consistent growth and dividends. Then you can layer in the other ETFs like JEPI, PDI, VNQ, or QYLD to boost your overall yield, according to your risk tolerance and income goals. Consider your personal financial situation. How much income do you need? What's your risk appetite? And what's your investment horizon? Reinvesting dividends, especially in these high-yield options, can supercharge your compounding returns over the long term. In summary, you've learned that it's entirely possible to generate robust passive income, potentially over 8% annually, with high-quality ETFs that protect your principal capital. No more worrying about NAV decay. You now have a solid understanding of SCHD and 4 other powerful income-generating options. Now that you have this knowledge, it's time to act. Research these ETFs further and consider consulting a financial professional to tailor this strategy to your specific needs. Which of these ETFs excites you the most? Do you already invest in any of them? Let me know in the comments below. If you found this video valuable and want more investment tips, don't forget to subscribe to the channel, turn on notifications, and give us a thumbs up. Your support helps me bring even more valuable content to you. Until next time, and happy investing.